Hello and welcome to the Financial Planning Basics webinar. There is no such thing as a one size fits all when it comes to financial plans. Every single person's is different. So today I'd like to walk you through some basic things that needs to be in everyone's financial plan. But first of all, I'd like to introduce myself as well as our team. So my name is Janenne Lackey. I'm a certified financial planner and I've been in business since 2000. I joined Wilde Wealth in 2008, and for my clients, I like to focus on everybody having a goal-based financial plan, which we'll talk about here in a minute. But once again, everybody's financial plan is slightly different. So when it comes to when you talk to your advisor and your team, I'd like to introduce you to our team. We have several investment advisors here in the local office of Scottsdale, but we also have additional offices throughout Arizona. We have one down in Tempe, one in Glendale, and one up in Payson. So we can service and help advise you no matter where you are in the Valley or in the United States. We also have a client service team. We have several individuals that help you personally with your accounts and help service your needs in that respect. We also have an events and marketing team, as well as a scheduling and client communications team. This team, or these three teams, help our office run very smoothly, and we give kudos to them. So you'll get to know them really well if you become a client of ours or if you already are a client of ours. So let's talk about the items we're going to cover today. We're going to talk about setting goals, about budgeting. Everybody should have a budget. An emergency fund. Once again, everyone should have an emergency fund. We're going to talk about insurance. We're going to talk about using credit, investing, tax planning, saving for college, retirement planning, and estate planning. So let's get started. Let's talk about setting some goals. So goals are very individualized for every person, but it could be as simple as paying off debt or saving for a car, buying a first house or our second house, third house, fourth house, or a vacation home. Saving for college is very, very big because that is a huge expense nowadays. And then retirement, how you want to experience retirement, whether it's golfing, whether it's travel, that's something you definitely want to plan for so you are ready to retire. So when it comes to goal setting, you want to make sure your goals are SMART. They are specific, measurable, obtainable, relevant, and timely. So if we start with specific, you want to be very specific when you set goals. I want to retire at age 65 with $6,000 net in the bank account every month to spend. It's very, very specific. You want to make sure they're measurable. Measurable meaning I have something to achieve. We can see every year we are getting closer to that goal. We're getting closer to achieving that goal. The attainable part is very similar to say, okay, I want $6,000 in the bank every month versus $16,000 in the bank every month. The $6,000 is going to probably be more obtainable than the $16,000 for the average person based on average salaries and income. So make sure that it's a goal that you can achieve. Making sure it's a relevant goal, a goal that you want to achieve and is relevant to you and your family. Retirement is relevant to most everybody. And then, of course, timely. I also think writing down your goals is super important. Put it in writing. It makes it real, and prioritize them. You might have 17 goals, so we need to know which one is priority and which one is least priority. So that way, when we go through and help you fund goals with your budget and your cash flow, which we'll talk about here soon, we know which one is more important for you to achieve. So let's talk about budgeting. Budgeting takes account your income, right? Your paycheck, rental income if you have that, government benefits, interest, and investment income. And then we subtract your expenses. You have your fixed expenses, which are going to be your rent, your mortgage, your car payment, your insurance, and then your discretionary expenses, going out to dinner, going to the movie, things that you don't have to pay every month. If you take your income minus your expenses, that's how you get your surplus. And that's when you start creating those goals that we just talked about, the SMART goals, and funding them. That's where the surplus comes into play. So let's talk about an emergency fund. Personally, I think everybody needs an emergency fund. It just depends on how much you need. I like to say everybody needs to have a minimum of 3 months of their earnings, their income in an emergency fund. I think 6 months is a good goal for everybody to reach, but some people like to have more. So if you have more than 6 months saved in your emergency fund, it's absolutely okay. There's always a personal preference and safety goal, right? What makes you feel good kind of thing. But it's also important to say, okay, where do you keep this? Do you put it under the mattress? Do you put it in a 0% interest-bearing account? Or do you have it in a money market that's at least earning some interest? So I like to say you should always have it in a money market that's earning some type of interest. And as we know, interest rates fluctuate. So obviously the more you can earn, the better, but at least have it earning something. So let's talk about risk management with insurance. So we have health insurance, fairly self-explanatory. A lot of people have their health insurance through their employers, but some people have it on a personal side. Either way, make sure you understand your insurance policy and your deductible. Auto insurance, we all have to have it. There are state minimums that are required with auto policies, but I always like to make sure you understand your policy and what you are paying for. I also like to have clients look at auto insurance and evaluate it every year, whether you do it or a broker for insurance does it for you. It's always making sure you're getting the biggest bang for your buck with a good company. Life insurance, right? There's lots of reasons to have life insurance, to help pay off debt if something happens to you, to help take care of your family, your spouse, your kids, if something happened to you because your income is no longer there, or estate planning, legacy planning. So there's lots of different reasons to have life insurance, and that's where to make sure, one, you are covered well and appropriate and for the right reasons. Property insurance, that would be home insurance. That's something, once again, you need to look at your policy and make sure you have the right coverage. If your house burns down, will you be able to afford to replace everything that's in your house? And for those that don't want to have to rebuild your house, make sure that's not a requirement in your policy. Liability insurance, same concept. We want to make sure that you have your liabilities covered. One example of a liability policy would be, say, an umbrella policy, to where you are covered above and beyond your auto and home policy by $1 million, $3 million. That's additional liability policies. Disability insurance, a lot of you probably have that through work, whether it's short-term or long-term, to make sure if for some reason you're not able to work, you still have income coming into the family. Long-term care insurance. This is a policy that helps cover you when you need long-term care. Your activities of daily living, you're not able to do those on your own anymore, so you need assistance. So that's something that you should always be discussing and making an educated decision on whether to have that type of policy or not. So let's skip from the insurance side to credit. All of us have credit. We have a credit score. So let's truly talk about using credit. So when you use credit, there are what they call 3 C's: capacity, character, and collateral. So capacity, you can actually only have so much credit. It is allotted to say, okay, you qualify for X number of dollars. The character and the collateral basically is the type of credit you have. So you've got credit cards that have no collateral. It is just someone or a company giving you credit to spend, but if you default, there is nothing for them to come back and get. Versus, say, your home, if you default on your home or your mortgage, they have collateral. They can come and get your home. So, right, depending on what type of credit you are using also depends on the interest rate. So, interest credit that doesn't have collateral is probably going to charge you a higher interest, aka credit cards, versus a home mortgage. It has collateral, is going to charge you a lower interest rate. So when you apply for credit or apply for a loan, the creditors, one, you have to fill out a credit application. They're going to pull your credit report and pull your credit score. In between those, that's how they're going to decide how much they're willing to lend you, as well as your interest rate. So let's move along and talk about debt. So when we look at debt, debt has lots of effect towards you. It's going to actually change your credit score depending on how much or how little debt you have. There's also, right, different types of debt. There's the secured debt, there's the unsecured debt. Going back to your home being the secured piece and the credit cards being the unsecured piece. But there's also, important considerations when you take on debt. You've got the monthly payment, you've got the interest rate, you've got the concept of how much this $100,000 loan is actually going to cost me. If you've ever bought a home, they have to disclose that this home, this mortgage payment over the next 30 years actually costs you X. So there's a lot of things to consider. When you are taking out loans, you want to consider the amount, the term, the rate, because of truly what that debt is going to cost you in the long run. So let's move on and talk about investing. The question I would have for you is, when you consider investing, do you consider it speculation, gambling for the most part, or do you consider it saving? This is for the long term. I'm going to make a methodical, thought out process of investing. And that's where investing really is a carefully planned and prepared approach to managing money, with, once again, the goal of accumulating the funds you need. So investing is an interesting beast, and depending on how you look at it, goes into risk tolerance. So understanding your risk tolerance is really, really important. You need to remember that risk equals reward. And though it's a really old saying, it does hold true. The more risk you're willing to take, the higher potential reward you will have. It also has the opposite effect of the more risk you're willing to take, the potential larger downside you have when it comes to investing. So once again, risk equals reward, and it's really important for you to know your personal risk tolerance. And sometimes people know I'm a conservative investor, or I'm an aggressive, risky investor, and I'm willing to take that risk. If you don't know where you fit on that category, right, you sit down with your advisor, you have that conversation, and we can help define where your risk tolerance really is. When it does come time to talk about risk, we need to look at the whole spectrum, right? I mentioned risk equals reward, and the more risky you are, the greater potential reward you have, but the potential loss. And that's something you need to be prepared for on both spectrums. So now that we've talked about risk tolerance, let's talk about some investment types. You have growth positions that are going to increase and decrease with the market. So the point of a growth position is to have it grow and increase with market value. You have an income position, which is going to be a little less, to have a little less movement on a day-to-day with the market as a growth position will, but it's also going to pay you income and dividends and interest. So it's going to be a little more stable, but then you have the true stability positions that are going to protect your original investment. So depending on where you are in life, what kind of goals you want to achieve, you might have one or all three of these types of investments. So let's talk about some tax considerations. For those of you that are employed, you have the ability to have pre-tax dollars, which are deducted from your paycheck before taxes are truly calculated. So this in turn obviously results in a lower out-of-pocket cost, a lower taxable income for you. Some examples of these are going to be your health or dependent care, your health insurance, your transportation costs, your 401k. So all of those come out of your paycheck pre-tax, and then you pay tax on what's left. Now, tax deferred growth is, for example, your 401k. No taxes are actually due until you withdraw those funds. So once again, it's deducted from your paycheck, goes into the 401k, and that grows tax deferred until you would withdraw it during retirement. In certain cases, qualified distributions can be tax-free, so be aware of that. Some examples might be a 529 college savings plan or a prepaid college tuition plan. Retirement plans, you've got traditional and Roth IRAs that do have some tax-free withdrawal options and reasons, but be very, very aware that there are penalties that are apply when you do take distributions in retirement plans before you're 59 and a half. So make sure you're aware of possible penalties whenever you take distributions from a tax deferred account. So let's talk about the value of tax deferral. So this slide shows us the growth of $10,000 invested in year one, and then what it grows to after 30 years. So if we assume a 6% annual growth rate and a tax rate of 24%, in a tax deferred investment, once again, you invest $10,000, it grows at 6%, and you have 24% tax bracket. At the end of 30 years, that $10,000 will have grown to just over $57,000. After you pay your 24% taxes, you will net $43,600 and change. Now, in an after-tax account, in other words, a taxable account, you pay tax every year on capital gains or income that you receive in that account. The $10,000 that you invest with the same criteria, 6% return, a 24% tax bracket, at year 30, you only have $38,100. So you can see the benefit of that tax deferral type of an account. So let's jump over to college savings or saving for college. A lot of parents, aunts and uncles, grandparents want to try to help their children or younger individuals get through college without having to take out loans. So a college savings plan is an individual account that traditionally has established portfolios. They are invested in the stock market, so you don't have guaranteed returns. It all depends on the position and investment you choose. Funds in college savings plans can be used for any accredited college or graduate program. They also allow for K through 12 tuition now, as well as some student loan repayment. So rules around 529s or college saving plans do change. So just make sure you're aware of all of those positions. Now, a prepaid college tuition plan is a little different. You actually prepay that tuition today. Your return is guaranteed. You are paying this tuition and it's going towards this college. It is limited to your state's plan. So understand the criteria, the pros and cons of each type of investment options that you're making for college. If you don't want to be restricted to certain colleges, then maybe head towards this plan, or if you know exactly where that child is going, it kind of helps guide you which plan you want to choose. So some basics of saving for college in a 529. It is tax deferred growth and potentially actually has tax deferred earnings. The withdrawals that you make for those qualified higher education expenses are not subject to income tax, but it could have a penalty. So just make sure that you use them for higher educational expenses. If you don't, then yes, you will pay income tax on them. You will have a penalty for that. And then there are obviously fees and expenses that vary with each type of plan. So let's jump from saving for college to retiring. And I know I used retirement as a goal earlier in the conversation, but right now let's talk about when should you start investing? And the answer is now. No matter if you're 20, 35, 45, 50, if you haven't started saving for retirement, the answer is now. So this graph is going to show us why saving earlier is better. Obviously, we're saving for the long run, but at the end of the day, you're going to see the potential of the growth. So for all of these individuals, the one at 20, one at 35, and one at 45, they're able to save $3,000 a year. And if they're able to get an average annualized return of 6%, the 20-year-old, by the time they are 65, will have $679,000. The 35-year-old that does the exact same process, they just wait 15 years later to start saving, will only have $254,000. Then the 45-year-old that starts saving, by the time they are 65, will only have $120,000. So you can see that the sooner you start, the better. So let's talk about retirement basics. When we talk about retirement, we really want to know, what kind of retirement do you want, right? Everyone wants a different type of retirement, but everybody wants to be financially independent. They want the freedom to do the hobbies or to travel, to have the choice, or in turn also the freedom of making those decisions on what you want to do today. The ability to live anywhere you want to. You might want to stay exactly where you are, or you might want to move to a different state. You might want to be a snowbird and have the best of both worlds, but also that requires two homes. Or the opportunity to provide financially for your children or your grandchildren. So really, when it comes down to it, the question is, what type of retirement do you want? And then, when do you want to retire? There's no wrong answer. Some people retire at 80. Some people go to 70. Some people retire at 50. But the earlier you retire, remember, the shorter amount of time you have to save and accumulate those funds, and the longer those dollars are going to have to last during retirement. Because don't forget, Social Security doesn't kick in until 62, and that's early Social Security, which means you're going to take a financial decrease or financial hit if you pull at 62 versus your full retirement age. Also, Medicare does not kick in until you're 65. So if you retire before you are 65, you need to make sure you have added into that retirement budget monies to take care of health insurance, because you will have to have that on the side. So how long will retirement last? That is the question of the day, isn't it? There is a an average life expectancy, but we also know that that expectancy and that length is continually increasing. So be prepared for your retirement to last at least 25 years. When I talk to clients and individuals about retirement, and we say, okay, when are you going to pass away? Once again, the question of the day. Most people, the goal needs to be at least 90, if not 100. So look back at your genetics, look back at how long your family has lived, and try to make the goal based on that. So now that we've talked about the concept of retirement, let's talk about the tax advantage saving vehicles. So, right, we talked about it earlier. Tax deferral can help you grow your money. We saw that in the slide before. How should you take advantage of that? If you are employed, take advantage of your 401k or other employer-sponsored retirement plans. 100% save as much money as you can in those, especially if your employer is matching. Can you contribute to a traditional or Roth IRA? And I would say if you can, absolutely contribute to a Roth, especially when you're younger. And then, right, don't forget that the 10% additional penalty tax only applies when you withdraw early. So when you are saving for retirement, you need to make sure that your other goals are also being funded, your emergency fund, these other pieces. So that way, if for some reason you did ever need funds before you were 59 and a half, you don't have to take them from your retirement vehicle and pay that penalty. So now that we talked about retirement, let's talk about some estate planning and some fundamentals around it. Most people don't like to talk about estate planning because it means we're towards the end of our lives, or we have passed on and now our heirs are taking and dividing our estate. A topic most people don't like to discuss, but a topic we need to be aware of. So there are several ways to plan for estate planning. You don't have to plan it all, and the state plans for you, or you take additional steps and you create a will or a trust. But it's also important to plan for incapacitation, because that obviously comes before we're no longer here. So if we look at not making a plan, the state has a plan for you. The question is, how does your plan, or how does your state divide things for you? So if you are, say, for example, a husband/father, and you pass away, in some states, your spouse or your wife would only receive 50%. And then if you had 2 children, they get the other 50%. So the question is, is that really what you wanted? And can your spouse live on only 50%? That's where making sure you are choosing what you want to happen versus the state choosing for you. So as you can imagine, there's many potential problems for not having documents in place. So let's talk about a will and actually creating a will to make sure your legacy or your choices are followed. A will truly is a cornerstone of an estate plan. It helps direct how your property will be distributed. It also names your executor and your guardian for minor children. If you have children that are under the age 18, you want to make sure the right person is raising them and caring for them versus the state stepping in and making that choice for you. You also want to be able to create an estate that could help minimize taxes. So there are other estate planning things that you can do in addition to wills. You can create trusts that will help with estate tax. But the key is, these are documents that must be written, signed by you, and witnessed. So these are things you actually have to step in, take care of, before you're no longer here, obviously, so that way your wishes are truly written out and it helps your heirs follow your wishes. So let's talk about planning for incapacitation. Um, as you can imagine, that can strike at any point in time. So having the docs done in advance, really important. Um, Not having the documents in place means whoever needs to care for you, whether that is help make medical decisions or pay your bills, they would have to go to court to be appointed as a guardian or as someone that can pay your bills. So having these documents in place, a power of attorney for medical and a attorney for financial, helps those individuals. They already have it in writing. It was signed by you. It was your decision that this person is here to take care of me, whether it's to make medical decisions on my own or make sure our bills are paid. If you plan, it actually helps those individuals, right? They don't have to keep going back to court to get more court orders. They're able to care for you in the way that you want to be cared for. So that's the other piece. Once again, if you put things down in writing, your decisions, your choices are there and help guide that caregiver, that guardian, to make the right decision and the decision that you would have wanted to make. So I know we talked about a lot of things today, and I went fairly quickly. So feel free to continue and rewatch this video as you like, because it is recorded. And reach out to your financial advisor with any questions that you may have. If you don't have an advisor, remember, we have a team of advisors in many different offices that are willing and able to assist you and answer any questions you may have. So I wanted to thank you once again for your time today. Have a wonderful rest of your day and happy financial planning.